Welcome, aspirants. In this explainer, we are going to break down the Reserve Bank of India's entire approach to financial regulation. This is an absolutely crucial topic for your upcoming exams, so let's get right into it. Okay, so here's our game plan for today. We're going to start with the big why. Why regulate it all? Then we'll get into why the financial sector is such a special case. After that, we'll explore the RBI's playbook, its core principles, and the tough choices it has to make. And you'll definitely want to stick around for the end, because we're going to wrap up with a rapid-fire revision section to make sure all these key concepts are locked in for your exam. So let's start with the absolute basics. Why does a regulator like the RBI even need to step into the marketplace? What's the fundamental reason for all this intervention? Look, markets are incredible engines for growth, no doubt about it. But they are not perfect. They have these inherent blind spots. I mean, think about it. If a seller knows a car has a faulty engine, but you don't, that's a classic case of information asymmetry. Or if a factory pollutes a river, that's an externality, a cost that everyone else has to bear. So regulation isn't about stifling the market, it's about correcting these flaws to make sure the game is fair for everyone. Okay, so if regular markets need a referee, you can bet the financial sector needs one on a whole different level. It really is a special case, and it's so important that we understand exactly why. These three traits right here are what make the financial world so uniquely, well, fragile. So pay close attention. First, you've got interconnectedness. This means a problem at one single bank can spread like a virus through the whole economy. Second, there's an inherent fragility that's just baked into the business of banking itself. We'll get to that in a second. And third, procyclicality. Now that's a key term for you. It basically means the financial system acts like a giant amplifier. It makes the good times even better, but it makes the bad times so much worse. And at the very heart of this fragility is a concept you have to know for your exams: maturity and liquidity transformation. Just think about how a bank works for a moment. You can walk in and withdraw your savings deposit tomorrow, right? But the bank has loaned that very same money out for a 30-year home loan. See the mismatch? That's the core business of banking, but it's also its Achilles heel. And here's how that one little weakness can spiral into a total catastrophe. It all starts with a simple loss of confidence. A rumor, maybe. Once depositors get nervous and start rushing to pull their money out, the bank is hit with a massive liquidity crisis. To pay everyone back, it has to start selling its long-term assets, like those home loans, probably at a huge loss. And just like that, a short-term cash problem morphs into a full-blown solvency crisis. The bank is effectively bankrupt. And listen, this isn't just some textbook theory. The 2008 global financial crisis showed us this exact scenario playing out with devastating clarity. When Lehman Brothers collapsed, it wasn't just one company failing. It was like someone cut a critical power line in a massive interconnected grid, sending shockwaves that brought the entire global financial system to its knees. Okay, so knowing all these risks, what guides the RBI? What's its compass when it's trying to frame regulations to prevent these kinds of disasters? Well, there is one single most important objective, a North Star, and that is maintaining financial stability. Everything else comes second, because the RBI knows that chasing short-term growth at the expense of stability can lead to absolutely catastrophic consequences down the line. Now, while stability is number one, it's not the only goal. These other objectives are also crucial pillars. You've got prudential aspects, like making sure banks have enough capital to absorb shocks. There's consumer protection. That's about protecting you and me. And of course, the RBI also plays a role in law enforcement and in directing funds towards national priorities. It's a really multifaceted job. All right, this next section is the absolute core for your exam prep. I mean it. These are the 5 key principles that really shape how the RBI goes about making its regulations. Okay, let's break this down with a simple analogy. A rule-based approach is like a strict to-do list from your parents. You must do X, you must do Y, you must do Z. What does that lead to? A tick box mentality, right? You do the bare minimum and then look for loopholes. In contrast, the RBI prefers a principle-based approach. This is more like broad guidance. Act with integrity and manage your risks. It focuses on the desired outcome, not just the steps, and that encourages a much healthier, more robust culture of risk management. So here they are, the big 5. The 5 principles you absolutely have to know. But how on earth are you supposed to remember them for the exam? Don't worry, we've got a way to make it simple. To lock this in, we're going to use a simple mnemonic, PPCER. Just think of the phrase, proper planning creates excellent results. Say it with me, PPCER. That'll help you instantly recall. Principle-based, proportionality, consultation, evidence-based, and review. Seriously, don't forget this one. Now let's dig a little deeper into proportionality. It's a simple but powerful idea. One size does not fit all. The regulation has to be tailored to the risk. I mean, it's just common sense, right? A huge, complex, systemically important bank poses a much bigger threat than a tiny cooperative bank. So it makes sense that their regulations should be tougher. And you can see this principle in action all across the Indian financial system. For example, those domestic systemically important banks, the DSIBs, the ones we consider too big to fail, they are required to hold much more capital. You see tiered regulations for cooperative banks and scale-based rules for NBFCs. This is smart, risk-sensitive regulation, not a blunt, one-size-fits-all approach. Now, making good regulations isn't easy. Not at all. It involves navigating this maze of complex challenges and really difficult trade-offs. These are the tough questions that keep regulators up at night. I mean, every new rule has a cost. Then you've got the boundary problem. What do you even do with something new like crypto? Is it a currency, an asset? And of course, there's that constant tightrope walk between innovation and stability. If you're too lenient, you risk a crisis, but if you're too strict, you kill progress. And finally, when a crisis does hit, there's enormous pressure for regulatory forbearance to just look the other way, which can end up planting the seeds for the next crisis. Here's a piece of key jargon you should definitely know: the regulatory ratchet. It's this phenomenon where regulation seems to only move in one direction, up. It gets more and more complex. After every crisis, there's a huge push to add new rules, but it's incredibly rare for old, outdated rules to ever get taken away. Over time, you're left with this tangled, ever-growing web of regulations. Okay, let's pull all of this together. This is your high-density summary for that last-minute revision. No distractions, no fluff, just the absolute core facts you need to know. All right, let's fly through the fundamentals. We started with market failures, things like information asymmetry and systemic risk. We saw how financial fragility is just baked into the banking system through maturity transformation and procyclicality. We established the RBI's one true North Star, financial stability. And of course, the 5 guiding principles, which you now remember with our mnemonic, PPCER. These are the absolute non-negotiables. And here are the key terms and, importantly, the real-world Indian examples that will make your exam answers shine. Talking about the regulatory ratchet or giving specific examples of proportionality like the DSIBs, this is what shows you don't just know the theory, you can actually apply it. That's what examiners are really looking for. So, we'll leave you with this final crucial thought. Regulation is not a static set of rules carved in stone. It's a constantly evolving discipline. It's a balancing act. And as the future leaders in this sector, your great challenge will be to foster game-changing innovation, while never, ever losing sight of the need for stability. Thank you for joining this explainer, and we wish you all the very best for your exams.